whole host of people behind the scenes who make this happen every week, and I'm going to show you their faces because they are incredible. Let me pull them up here for you. So these are the faces of the people who do all the hard work. Although you're seeing my face, they're the people who do the logistics and organizing our speakers, and we're also sponsored by Echo Factory. So we are grateful for their sponsorship. And we're grateful for all of the efforts that these volunteers put in each week to make this happen. We are also grateful for our attendees. Thank you for being with us. There are a few logistical things that I want to cover in order to make our session easy for everyone this morning. As I mentioned, we are on Zoom. We will be taking all of the questions and answers this morning via Zoom in the Q&A panel at the bottom center of your screen. Although we have the chat window open for everyone so that you are able to say hello to your friends, that area is unmoderated. So don't put your questions there. Add them into the Q&A panel at the bottom center. If you are on LinkedIn Live and you want to ask a question, we have put the registration link into that information. You can join us over on the Zoom and ask your questions there. So we are glad that you're with us this morning. We are so excited to have Jason Schoettler with us this morning. He is going to be talking to us about the ins and outs of seed to Series A funding. He is part of our community. It was exciting this morning to talk about some of the connections that he has within our community. So it's always great to have someone with us that is so embedded. And he is the co-founder and managing partner of Calibrate Ventures. There they are looking at investing in visionary entrepreneurs that are looking to make changes in the world. So we are excited about that. He sits on a number of boards for the Calibrate portfolio. These include companies like Embodied. We know Paulo. Paulo's spoken for us before with Moxie. So we're excited to hear from somebody who has helped with that company and being there on their board. FarmWise, Paired, and Truck Labs as well. He is also an executive member of the Alliance for SoCal Innovation, their VC advisory board. They're another one of our friends who spoke with us a couple of weeks ago about the Southern California venture pipeline. So we are glad that he's here, and he actively works within that community to promote venture capital as well as entrepreneurship in Southern California. Welcome, Jason. Thank you for being here with us today.
Delighted to be here. Thank you.
So great to have you.
There we go. Yeah, it's great to be here, and I want to thank you for inviting me. And this is a great community, both in terms of technology, very rich and steeped in technology, but also from a finance and entrepreneurial perspective. There's a lot happening here in the area, as there is all over Southern California, as we've seen in the recent decade, a real growth. And a lot of that also stems from the great academic and research talent we have around town with JPL and Caltech. And I'm sure a lot of folks are either loosely aware or very deeply embedded with those organizations. So it's great to be here.
Welcome.
I thought I'd
over to you.
Yeah, great. I thought I'd start. I love conversations, and so I'm most excited to get to that part of our time together. But I thought I'd talk a little bit about the Series A process, specifically around really three areas. The first is, what is Series A? What does it mean? The second is, how do Series A investors think about Series A? What are they looking for? And then also talk then thirdly about the process of running an effective fundraising to secure some Series A funding. So those are the three areas that I wanted to touch on. If folks have interest in probing in some other areas, happy to do that during the Q&A session. Let me start with a little background on me. I graduated from Notre Dame in the late 90s and went to the Drucker School of Management out in Claremont, not too far from here, where I got my MBA and met my co-founder and partner, Kevin Dunlap who I've been working with now for 20 years. I've been in tech my whole career. I started my career in the Bay Area and left in 2002 to come to Pasadena to join a startup that was spinning out of JPL and Caltech. I moved down here in 2000. It was a wonderful time to set up roots here and to start my time here in the community. I joined Shea Ventures in 2002, which is the venture capital arm of a local family that's been active in venture going back to the late 1960s, and worked there until we spun out and formed Calibrate in 2017. So let me just briefly tell you a little bit about Calibrate so you understand the perspective that I'm bringing when I'm speaking. We are an early stage venture firm that's investing in high growth companies that are driving transformation throughout all different pockets of the economy using advanced automation and digitalization technologies. So, we're investing behind horizontal platforms as well as vertical applications that are using artificial intelligence, machine learning, autonomy, and robotics to bring and deliver value to customers throughout the economy. We're raising. In terms of financing, we've raised our second fund, which has been great. So we've got plenty of fresh capital to invest, and we have 3 venture partners that have joined us, 2 of which are local. One of them is actually Paolo, who you mentioned earlier. I've known Paolo for about 10 years. He's one of our venture partners, as is Dan Murray, who's also a local Pasadena resident, and he was previously CFO at Dollar Shave Club, which was an investment we made many years ago. So that's a little bit about us. We don't invest exclusively in Southern California, but we love Southern California, and it's been a very good place for us to work and to drive results. So let me talk a little bit about what we look for when we're investing. We really prioritize around 4 different areas. The first is the founder, the second is the market, and the third is early signs of commercial success, and the fourth is a deep understanding of unit economics. With founders, we learned many years ago that it's all about people. So understanding, getting to know the founder is a really important part of our investment process. We look for founders who have talent, who have character, and who have grit. I mean, if we were to boil it down to 3 bullets, those are them. And we love to get to know founders over some period of time. So don't be shy about reaching out if you've got something you're working on that might be a little too early for our focus area. In terms of the market, we would look for attractive market dynamics. At our prior firm, we were investors in Ring, and I think that's a great example of an attractive market dynamic where there's an old incumbent, in our minds, that's ADT in the old line security industry, and a new disruptive incumbent that Jamie started with the company Ring, came in with a new technology and a new distribution model that very quickly took over. And so opportunities to come in and disrupt incumbents is huge, as is developing new technology platforms that unlock new markets. And locally, I think SpaceX is a great example of that. In terms of company traction, and we'll dig into this a little bit deeper, we really look for companies that have early signs of commercial success, early signs of customer success, and of revenue traction. We have a perspective on what that means, but for us, it's typically the companies have between $500,000 and $3 million in revenue at the time we engage with them. And while they may not have fully proven out the unit economics of their business model, they have a firm understanding of where those levers are, the limitations of those levers, but also ways to drive value for not just customers, but for a profitable business as well. So we do look for a deep understanding of that, and I think that's an important part of most investors who are investing in Series A, what they're looking for. So what does Series A mean? I think that it means different things to different folks. But in general, and I think it can all fall into the bucket of if I oversimplify it, it's all about the customer. In recent months and quarters, we've seen Series A fundraisers happen for companies that have no revenue and companies that have significant revenue. And we've seen valuations range from the teens to over $100 million. So it is a very wide term, and we don't get hung up on it at Calibrate as much as some other places might. We're more focused on the company and its stage of development, and whether it fits into our model more than whether it's a seed or a A or even a B. But I thought I'd just maybe talk a little bit about risk profile as a helpful guide to understand where Series A fits. So as I think about the venture landscape and investing in venture, there's a number of key risks. There's product risk, there's customer risk, there's market risk, team risk, and financing risk. These last two, team risk and financing risk, you have those throughout the journey for any company, from a startup to a Fortune 500 company. Those are always there. And so I'll set those aside because I think in the venture landscape, if you look at product risk, customer risk, and market risk, they kind of line up neatly with seed investors, Series A investors, and Series B or later stage investors. And when you look at our friends that do tremendous seed investing, they're looking for companies that have vision, that have an idea, and a very strong core team that they're able to build a product with. But typically, the risk being taken there is product risk, as well as the later stage risks that come. But that's really the underwriting risk that's taken at the seed stage. Where we invest and where most Series A investors come in, there is a product. Sometimes there's a lot of revenue, sometimes there's no revenue, but in general, the team has proven out that they can build a product. Product works, and there may be a number of questions around product market fit or unit economics, but in general, the real question is about customer value. And I think that's a key thing to focus on as you're thinking about your Series A investment. And then the later stage risks, really around market risk, as I said, that's really around revenue velocity, unit economics, and driving scale for the organization over time. So let me drill down a little bit into what I mean by customer and Series A being all about the customer. I think there are a couple of key questions that I use when I'm talking to a founder or entrepreneur about their business. And the basic questions that I start almost every meeting with is, who is your customer? What is your customer value? How much is your customer willing to pay for that value? Or how much do you think they're willing to pay for that value? And then can you make money and build a business based on what they're willing to pay? I would suggest that if you don't have an answer to those questions yet, you're probably not quite ready to go out and have a successful Series A. So I would encourage you to really think about and focus on those types of those questions around the customer. And I hope this raises some additional questions that we can chat about when we get to the more interactive Q&A session in a few minutes. So I really, I think that look at the customer engagement and customer intimacy. You need to be able to answer those questions in a way that shows the potential investor that you have real deep insight into what the customer needs are, what the customer landscape looks like, how customers think about you and your product. Is it so brand new that there's no predicate or no budget for it, or is it something that's really going to fit into an existing buying pattern and solves a real key pain point that they're dealing with? For me, I would really focus the entire conversation around that journey from seed to Series A, being really digging into the customer and what that customer needs. Let me touch on process a little bit here as well. I really think that fundraising fundamentally is a courtship. It involves elements of attraction and salesmanship, but it also, very importantly, it involves seeking alignment and seeking fitness in a partner. I think in the best processes that I've been a part of, it's a bi-directional courtship, meaning it's not just the founder feeling like it needs to go sell somebody on investing in their business. It means that I have to do the same thing as a VC, that I need to pitch myself. I need to have bring something to the table other than just capital. And there needs to be a fit between the founder and the partner at the firm to be able to have a successful relationship and scale a business. So I think that's an important frame of reference to bring to the table, and realize that while it can feel a little bit one-sided at times, it really is ultimately about finding a fit with a partner that's going to help you scale and drive results in the future. So let me talk about the process a little bit and give some insights from where I sit. First thing I'd say is you've got to do homework. You've got to do your homework. There are dozens and dozens of excellent investors throughout the landscape, and identifying which partners at which firms make the most sense and have the most to offer you is really fundamental. Who is the partner? What is their background? What is their level of expertise? What's their standing within their firm and then within their fund? Larger firms oftentimes have senior partners and junior partners. At Calibrate, we're a partner-only firm. There's just two of us, which makes for fast decision making and not a whole lot of politicking. But there are politics involved in venture funds, and understanding who that partner is and where what their standing is within the fund is a really important question to ask that sometimes gets glossed over. So do your research, figure out who the partner is at the firm, and how to approach them. Also understand from a sector and stage perspective, does that firm invest in only seed? You don't want to approach somebody for a seed investment who's a Series A. I get hit up all the time for seed investments, but that's not our core focus. And it's a waste of their time and a waste of my time to even send that email. Understanding their market knowledge and past investments that they've made, past successes they've had, past failures they've had. All of those things are important research elements that should be done ahead of launching a Series A process. Referenceability is important. You want to work with people who reference well, obviously. And asking friends and founders and others in your network about what they've heard or experiences that they've had are important. And because we're so socially connected these days, it's pretty easy to find out who's connected to who and how to get a read on a firm or on a particular partner. This all sounds very easy and rudimentary, but I will tell you that the number of times that people don't do their homework, it shows when they come in for a pitch where there's a mismatch, where they ask for an introduction, and it also shows when it can be a very frustrating and waste time further down the line in the process. So do your homework up front. The second thing is getting an introduction to a partner. There's lots of different ways to do that. I would say I have seen the best success, and I advise founders that when she's looking for an introduction, she should get an introduction through another founder that partner has worked with. I think it's really important to drive on personal relationships, and the fewer degrees of separation between that you can get in that introduction, the better. So I think founders are an excellent source of introductions. Secondly, seed investors. If you have a seed investor, in their network and their relationships, obviously a great way to get introduced to a potential investor. And then I think the further out you go from those concentric circles, the more challenging it can be to get a successful introduction, to get that attention. But certainly others in the network work as well, whether they're business contacts or other people that just happen to know friends. So that introduction is really important, and I would encourage you to focus on as few degrees of separation as possible as you can get, with a founder introduction being most compelling. As I said, I view the fundraising process as a long one and a courtship, and I think building relationships is key. Ideally, that courtship happens over some period of time. I always most appreciate folks who reach out, well ahead of their fundraising process, and I appreciate it less so when there's a clock going and you've got to get your term sheets in a short period of time. And I think that's important because I do view it as a long-term partnership. This isn't the work that we do. We invest an enormous amount of time with our founders and want to see them succeed and their teams succeed. In many cases, it's can be a decade-long partnership, and it's very important to understand going into that relationship as much about that other person as possible. It's both true for the VC and understanding the founder, but equally important for the founder to understand the VC and the partner that will be working with them. So I'd encourage you to build those relationships well ahead of time. It allows that courtship time to, do a little bit of salesmanship, demonstrate why you're an attractive company, why you're an attractive founder to back, why the market you're going after is particularly attractive. But it also gives you a time to evaluate the fitness, the fit, and the alignment that you have with the founder, with the VC, and the same is true vice versa. We also love to watch execution and progress and milestones. So, starting to build that relationship over a quarter or two or a year gives me as a VC the opportunity to watch execution and see whether the company can deliver. If you set expectations, are you missing them or are you exceeding them, and really getting me excited about the progress you're on. And then sometimes building that relationship ahead of a fundraising process or a need for fundraising allows the VC an opportunity to preempt a Series A and offer a term sheet ahead of officially running a process. I think the next step, if you look at the process, is in the pitch and when you're actively fundraising. And this is a sales process. When you're actively doing this, it's less about the courtship and more about execution and running a very well managed sales process. And when you're running any sales process, you need to understand how much capital is available. You need to understand authority, which is, what is the authority and the decision-making process within that firm. You need to understand the need, whether there's a fit from a perspective of what you're offering and what they're interested in investing in from a stage and sector perspective. And then obviously timing. You don't want fundraising to take months and months and months. So driving a constrained and understanding whether the timing will work for that venture firm is important as well. And so, that for me, budget, authority, need, timing, that's a very, it's an acronym, BANT. I would encourage you to really think about the fundraising as a very tight sales process that needs to be focused on 100% of time while you're in market, and make sure you're doing the qualification and the steps that follow a sales process to have success. On the softer side of running a process, I think there's a couple of things that I would offer. One is to be reasonable. I mean, it's important to be firm, but it's also important to be flexible and understanding where the puts and takes in a negotiation are important, and having that relationship built over some number of months or quarters will give you some insights into where the contours of that relationship can bend. So be reasonable, firm, but flexible is important. Also, two other points. One is, I would say it's really important to listen to feedback that you get in every meeting. I don't think you have to take that perspective as sacrosanct out of every meeting, but everybody has different experiences and different perspectives they bring to the table, and being able to internalize the feedback and consider it and whether you want to take some action on that is important. I think there's a lot of smart people in this world that have a lot of experience to draw on and a lot of good advice to share. And so always be listening as much as storytelling when you're in partner meetings, because what they're asking will shed some light into a business opportunity perhaps, or maybe have you consider something that you hadn't considered before as it relates to either your sales process or your business. Finally, when you have your pitch with a firm, realize that it's not the end all. The goal in a pitch with an investor is to get a follow-up meeting where you can explore more deeply the opportunity to work together. Going to make a pitch in front of a partnership can sometimes be a little unnerving. They can be hostile, they can be friendly, but I think if you go into that meeting understanding that your goal is not to win over the entire partnership and walk out with a term sheet, that may happen, unlikely, but it may happen. If you go in there and just set the goal, I want to show well and I want to get to the next step, which is a follow-up meeting with the partner, then you'll understand that it's a much longer process than just that first meeting. And I guess maybe the final point to talk about, we could do a whole nother talk on this subject, which is the term sheet. I don't want to spend too much time talking about terms and all of that. I really wanted to talk more about the process and how do you get from a seed to Series A. But I think when you're considering term sheets and you're considering an offer of investment from a venture capitalist, you should optimize for success, which is not necessarily the same thing as valuation. Someone many years ago mentioned to me, and it's a very commonplace phrase in finance, that you want to buy a great asset at a fair price, not a fair asset at a great price. And I think that's extraordinarily true in venture capital. And I would say that that's true both as a VC making a cash investment, but also an investment that a founder makes in the asset of the venture capital partner that she's picking to work with. You don't want to over optimize and get a high valuation and get somebody who's mediocre to work with. You really want to find a partner who you believe will best support you and best support and provide a leverage for your company on your journey. And one reason why I say not to over optimize for valuation at the Series A stage is that if you over optimize and raise capital at too high a valuation, you can get stuck when you go to raise your Series B or your next round of financing. And what I mean by that is if you've raised at too high a price, but your business metrics haven't grown into that valuation, then there's trouble ahead. And getting that next financing done may be more challenging than you'd like. And I guess just realize that this is it can feel like a cage match raising money. It can feel like a big battle. But remember to breathe. It's a process. It's one step, and it's an important step. But it's just one step in building a business and the journey of building and creating something that's your vision. So I'd love to maybe turn now, if we can, Christy, to some questions that have come up and open it up for more of an interactive discussion at this point. I'm sure that I've touched some nerves, or at least touched on some points that people want to dig into. So if there's questions, I think now would be a great time to open it up.
Wonderful. Thank you so much, Jason. That was very informative. We touched on a lot of points. For those of you on the Zoom meeting, go ahead and put your questions into the Q&A panel. There was an initial question about the video. The video is currently streaming on LinkedIn Live, so you can find it there on my profile. I put that in the chat. It will eventually make it to YouTube, but we've had some delays on that. So if you want it right away, check LinkedIn Live. Jason, can you tell us a little bit about what your experience has been during COVID and what you're seeing now as we kind of head back out again?
Yeah, it's been amazing, and I mean that in like, I never imagined we'd go into a pandemic where we're all working from our homes for some period of time, and then I think we've snapped back as an industry very quickly. I'll touch on that mostly from a what are we seeing in the marketplace? We are seeing a lot of activity. We are seeing, in my view, somewhat of a divergence of fund in the fundraising market between the haves and the have-nots. And what I mean by that is, you read about a lot of financings happening. There's a lot of growth stage capital out there that is very actively pursuing companies that have, identified that product market fit and are scaling in very attractive markets. But I would say for every headline that you read that somebody raised, X tens of millions or $100 million of capital, there still is challenging. It's still challenging in some pockets of the ecosystem to get that traction. I think part of that has to do with venture capitalists really doing two things. One is looking to leverage, the growth, as a number of companies have really shot up their growth rates through the pandemic. Technology is definitely leading the way out of this. So I think there's a real focus on companies that are driving value and growth aggressively on the tailwinds of COVID. And I also think there's at least early on in COVID, there was a little bit of risk aversion. And so retreating to relationships that you've built over decades for sourcing, I think that's less so now. I think people are starting to get back out there now. But I'd say that it was a very active time, far more active than I thought it would be. We, from our perspective at Calibrate, we have now completed, I think, 6 transactions, which is a lot for us, over the last 6 months, and it's been a very busy time. And people are taking meetings. They're doing it over Zoom. I think there was an initial hesitancy about, would you be able to actually meet with a founder and get to know somebody over Zoom? My preference is always to meet in person. And so I've done some hikes and some outdoor meet and greets with folks. But a lot of people have just, moved to Zoom, and that makes it a lot more efficient to be able to get in and hop on a call and learn about a business. So I would say that we've gone through this really accelerated time frame where everybody that I've talked to, all the other VCs I know, the lawyers are all busy. It's been a very robust time frame, but I would say that I don't know that it's going to sustain like this in the future. I think it may slow down a bit, but for now it is a very robust financing market that we're seeing. Great.
We have kind of a technical question. Can you talk about when you can get an investor to sign an
NDA? I don't sign NDAs. So maybe there's that's an answer that maybe wasn't desired. And I'll tell you why we don't sign NDAs, and you can decide whether that's whether you want to pursue that or not. The reason why we don't sign NDAs is because we meet with dozens and dozens of companies every year. And if I signed an NDA with everybody that I met with, it would first of all just be an administrative nightmare to kind of manage all that. The other reason why we don't want to sign NDAs is because, or why we don't sign NDAs is because we may find somebody who's doing something very similar to you, and that may be a challenge in terms of our knowledge, and we just don't want to be in a position where if we invest in two companies that are competing, it just becomes a Pandora's box. As a policy, we don't sign NDAs. That doesn't mean you shouldn't ask for it, but it also means that you need to be very careful about what you share. And even if you do sign an NDA, you should be very careful about what you share until you understand where that relationship is headed. I always tell somebody when they meet with me, I will treat things as confidentially, but you should not tell me anything that we got to get to know each other. So there's different levels of comfort and confidentiality. Certainly, as we get deep into diligence, the cone of silence can broaden. But I would say you asking for the NDA up front can be a chilling, kind of a chilling thing to ask for in the process of fundraising. So technically you can ask for it whenever you want, but I would say if you're working on something that's very much trade secret, I would try to find out when in the process it would be the appropriate time to do that, because it is a big step for somebody to take.
We talked a little bit around determining Series A valuation. Can you delve into that a little bit more around what the metrics are? Is it a revenue multiple or other factors that you think are critical? I know you said don't go too high. So if you can touch a little bit more into that.
Sure. Yeah. The valuation, I'd say Series A has a very broad valuation strike zone right now. I will tell you, I know there was a company that had just secured its first, $10,000 of revenue that signed a term sheet at a valuation north of $100 million. And I know that there are companies that have got, in my view, that's very early and a very large value, a very high valuation. There are other companies that have, got $3, $4, $5 million of revenue, and they're raising at something in the 20s, maybe the 30s. So it is a very broad range, and I would say that the metric or the strike zone that we look for is we invest in companies that have valuations between 20 and $60 million. That's the strike zone that works for us in the way that we both the stage of companies that we want to invest in, and also the amount of capital we want to invest in, and the like. I think candidly, the notion of a revenue metric is probably a little off because in Series A, that revenue is often, well less than $5 million. And so I think there's maybe less of a rule of thumb around that, at least from the way we think about it. But I think in general, it is a negotiation that needs to take into consideration, ownership for the founders, ownership for the Series A investors, and importantly, not getting stuck. And if a company's raising a $20 million financing at $100 million pre-money valuation, so they're sitting at 120 post with zero revenue, they better make sure that they can get to some meaningful metric so that when they go out to raise the next round of capital, that it's at least at $120 million valuation or better, or there's going to be some challenges. I alluded to this a little earlier. We've seen this happen time and again. And so I would just encourage people to think about, talk to your friends, talk to the other founders about where they're seeing those valuations settle out. And again, look for something that is a fair valuation with a great partner, as opposed to necessarily optimizing for that every last dollar of valuation in the negotiation.
Great. And if you do have a question and you're on the Zoom meeting, go ahead and place that into the Q&A panel. One of the questions that came in was around the risk profile, and if, product, customer, market, is that weighted for you? Or do you feel it's weighted in some way?
I think as we think about investing, the product risk is typically mitigated to some extent for us by a company has to have a product in market or in some sort of pilot configuration. So that is somewhat mitigated. It's always a risk. Anytime you're building a product or launching a new product, there is risk, even for mature companies. So I would say that is less of a risk than, as I said, really the customer risk, and really doubling down on what the customer value is, and whether you're able to deliver a very strong customer return on investment. That's something that I didn't touch on, but certainly being able to articulate what the return on investment the customer is going to get is important. Customers love technology, but they also want to earn a return on the investment they're making in the product with you. So I think being able to articulate that's important. The market risk is the biggest risk that we do take. And what I mean by that is, the companies haven't really proved that they can go scale a company and drive into a market and identify how big that market is. That is the biggest risk that we're taking. We have some idea about how big that market is when we make the investment, and we key off of that those early customer reference calls with the early adopters to understand what the potential market size is. But I would say that's the biggest risk we take. But we focus mostly on that customer value because we typically will screen out markets that we don't think are attractive. So if we're engaging in a conversation with a founder, we'll understand what her view on the market potential is. But then we'll really listen to, well, what are your customers saying about the value proposition for your product?
Last year, the comment was last year, SaaS valuations took a haircut. Do you feel like they've rebounded this year?
I think I haven't looked at it recently, but certainly SaaS multiples in the public markets were up significantly. I should have looked that up beforehand or had that at my fingertips, but I do know that the SaaS revenue multiples in the public markets were very high last year, higher than the kind of average for the preceding number of years. I think that dissipated in the first quarter a bit, but they're still, I would say, relatively high relative to historic norms. Now we can argue, and I don't have a particular point of view other than like looking at that fact and making, I don't infer too much from that, except that that's kind of the fact on the ground. We tend to think that technology is going to drive value, and do we think that the goalposts for SaaS valuations are getting moved up permanently? Tough to say. We look at the public markets as an indication, but in general, we still try to keep things. We at Calibrate try to keep things in that strike zone that I talked about up top. Certainly, there's a lot of money looking to invest in high growth companies, and that's part of why you see that multiple going up, because folks are bidding up those prices to get access to those high growth companies at the later stages.
There's a question around kind of what environmental, social, and governance factors weigh into your investment decisions. How important do you feel in a startup that those types of factors are important in getting investments?
That's a great question, and ESG has, which is the acronym or the for that is becoming more of a thing. Our investors, our limited partners, are starting to ask questions about that, and while we are, we have a particular policy or point of view on that from our investment mandate. We do not specifically look for exclusively those sorts of companies. And I would say that from a screening perspective, that's certainly something that we talk about and it weighs into the decision. But I would say it's not going to, if we don't have conviction around your customer base and the market you're in, and, you as a founder, that's not, if you have an ESG policy or an ESG play, that's not going to get us over the finish line. It's an important consideration. And something that we look at. At Calibrate, we've invested in a couple of companies that play nicely to that degree. One of the ones that I love to talk about is FarmWise, which is autonomous, which is an autonomous vehicle for farmers to help with weeding. And because of that, farmers are able to use less pesticides. They're able to monitor their crops more efficiently and use less chemicals in their growing process. And I think that's a great example of a company doing that without, they see a market opportunity and a market demand for that, and the ESG follows that, as opposed to saying, they want to be ESG first. But it is something to talk to your investors about, because we're hearing more about it from our community.
You touched on entrepreneurs having other founders introduce them into investors. Say there's a new founder and they have no connections in this area. What networking would you recommend for them to start kind of learning who the other entrepreneurs are and start making those connections?
Friday coffee meetups are great. I mean, I think it's a great place to start. You got to start somewhere, right? So I think that you will find online communities as well as kind of in real life communities of founders, and I think that in my experience, founders are very happy to share their network and be open with their perspective and help other founders along the way. And there is no substitute to having a community of people that you can leverage. And so networking is a very important part of being a founder, because it will help you find talent, it'll help you find capital, and it'll help you find customers. And so it's an important part of the process. And I don't know if there's an ideal place or community that I would point to, other than just do it. You've got to be out there, and you've got to be building those networks and marketing yourself a little bit. So I would encourage. It's kind of like marketing. You should just be doing it, and you'll figure out what's a good network for you and what's not. But it's important to build those relationships.
And what do you feel were your greatest or worst investments, and what do you think contributed to their successes or failures? That's a big question.
That is a big question. I would say that where we've had success, it's been driven. We've kind of hit all the core things that we look for. You've got a founder who's extremely talented, has got character, and has got grit, and is going after a big vision, a bold vision. Michael Dubin, Jamie Siminoff have kind of had great exits and definitely fit that mold, as others have as well. I think the alignment piece with us is important. If there's not alignment around the shareholder base, or there's not alignment with between the founder and its investors or its board, that's where things can get really dicey. And I think that, so I think focusing for us, we really focus around alignment, that all the incentives from the founder to us are aligned. And the reason for that is if the founder's making money, then our LPs are making money. And if our LPs are making money, we're making money. So getting everything to kind of snap into alignment is really important. And then I would say founders who, this touches on the networking comment, founders who surround themselves with the best and brightest people, they may not be immediately in their network, but surrounding yourself with the best and brightest is really important. And, not settling when it comes to the people that you're recruiting or your expectations has also been, I think, a characteristic of successes that we've had. And there's dozens of reasons for failures. I mean, markets are things that you don't control. You can't control people. That's why we really try to optimize for investing with great people, making sure we have alignment with them, and then helping them, build out their vision is really important.
I had to look up another acronym. And so this one has the current flare of interest in SPACs, which is a special purpose acquisition company, and the potential for a lower friction public exit. has that changed how you and your founders are considering the end game of managing the investment?
Yeah, so this is the SPAC comment, and this is a whole nother series of talks probably. But SPACs have been around for a very long time, and there has been a craze in the last 6 to 9 months of a number of SPACs getting launched. I think that like any financial instrument, SPACs have a role to play in the ecosystem, and I think that from a portfolio company perspective, I'd say 80% of our portfolio companies have had some discussion around SPACs or had specific discussions with SPACs around doing a transaction that would accelerate them to become a public company. The answer to the question is it has not changed our focus, but it's actually a very good thing for the ecosystem because it's another alternative way to access the capital markets. So, for those that aren't familiar with what a SPAC is, it is essentially a public shell or an entity that goes public and then attracts capital and then goes out and acquires a business. For purposes of this conversation, a private venture-backed company. And when that acquisition happens, that company that's acquired ultimately becomes the surviving public company, and then it's a way to get companies public and access the public markets, which has lots of benefits, lots of trade-offs and costs as well, but it's a way to access the public markets. And I think there's a place for it. It hasn't changed the way we build companies. It hasn't changed the way that we think about exiting businesses, but it is a new avenue for us that is definitely something that we're talking about at the boardroom.
Can you tell us a little bit about your work with the VC Advisory Council for SoCal Innovation? And are you one of the companies that the new SoCal pipeline that companies could be connected to? Can you talk a little bit about that?
Sure. It is, and we are. I've known Andy and the Alliance for a long time. Andy's one of the first people I actually met when I moved down to Southern California. So known him a long time, and a big fan of the work that they're doing to drive the entrepreneurial and technology and venture community here in Southern California. And so it's a great group of from a venture perspective, they pulled together a great group of the local VCs who are actively looking to share ideas, share deals, and share networks to build the entire ecosystem here in Southern California, and we're delighted to be a part of it. The venture pipeline thing is also something that we're involved in and interested in. I think it's earlier days for that, so I don't have any real proof points that I can point to, but it certainly is. And our friends at SVB, Silicon Valley Bank, have been great. Rob and his team, I know, are involved as well. So it is something to pay attention to.
Wonderful. And we did put out, for those of you online, that is another way you could get connected into possible connections to venture. So take a look at that. We posted it previously, how to apply for that. So it's the Southern California Innovation Venture Pipeline. So take a look at that. To round us out, you are on the board of Embodied. Paulo has spoken for us. We talked a little bit about that. Can you talk about any highlights or excitement that you have around what's happening with Moxie?
Yeah, I've known Paulo for over 10 years now, and invested in his in Evolution Robotics, and stayed very close to him while he was CTO at iRobot following that acquisition. And he always had a passion and a vision for the good. This kind of gets back to ESG a little bit, but the good that technology can bring to the world, particularly around ways that Moxie and that technology platform can help different groups of our population. The elderly being one that we've been talking about for a very long time. So Moxie has been released and is now in the wild. I don't know when you had Paulo on, but they've only been shipping for about 2 months. So the results have been, I would say, very positive in terms of the in terms of the engagement and the feedback that we're getting from customers. And it's still early days because it's only been 2 months, but we're very excited about the feedback that we're getting from customers about how children are being helped by Moxie. And I think it's also opened up a much wider interest from, now that it's out there and in the wild, a much wider interest from other industries as well. So it's a great product that's having success with its early customers, and I think there's going to be a lot more to come from Paolo and the team at Embodied here locally. So stay tuned for that.
It's exciting. Well, we're about to wrap up. For those of you that are online today, we aren't going to be able to do networking today, but I have put Jason's information in the chat window. Jason, did this bring up anything else, through all these questions that you'd love to share with us today before we wrap up?
No, I think I've done a couple of these over Zoom, and they're great to do over Zoom, but I look forward to doing something in person when we can, because I think there's nothing like being able to chat over a cup of coffee in the morning, or in the afternoon over iced tea or a beer or something. So I'd love to. What it brings up for me is just how important these events are and how important it is to be active and involved in the community, and would love to join the next one when it's in person.
Thank you.
So thank you, Christy. Great community you've got. Yeah.
Yes. No, we're so pleased to have you here, and thank you for coming and spending the time and sharing with our community, sharing your wisdom with us. So thank you for that.
Sure.
Our next meetup is going to be on June 18th. We are doing the first and third Fridays of the month, just a reminder, and we're going to be having Marie Rippon on Lab Launch. She is going to be talking about becoming a for-profit to achieve nonprofit goals. Again, for those of you online, we didn't get to all the questions, but feel free to reach out to Jason. Thank you to Jason. Thank you to the Friday Coffee Meetup team. And everybody have a lovely weekend and take good care. Goodbye.